I'm Michael Lux, and I'm the founder of the Student Loan Sherpa. Today we are going to be talking about the different federal student loan repayment plans. The plans we'll be covering include the standard repayment plan, the graduated and extended repayment plan, as well as the many income-driven plans. This includes income contingent repayment, income-based repayment, pay-as-you-earn, and revised pay-as-you-earn. The goal of this video will be to present how these different plans work and to help you formulate a strategy for your student loan repayment. The first plan we will look at is the standard repayment plan. This is the default plan, meaning when you get your first student loan bill, it is based upon this plan. If you haven't signed up for a student loan repayment plan, this is the one you are on. The standard plan is a 10-year plan, meaning if you pay all your bills in full for 10 years, your loans will be paid off. For most people, it also means it's the highest monthly bill and the most expensive plan. Two repayment options are the graduated and extended repayment plans. Now these plans are nice because it gives you an extended period of time to pay off your student loans. By extending the length of time to repay your student loans, you get lower monthly payments. The problem with extending payments is that it means over the life of the loan, you will spend more on interest if you just make minimum payments. Another issue with these loans is that they're a relatively outdated option. New plans, like the income-driven repayment plan, pay-as-you-earn, and revised pay-as-you-earn, are significantly better choices for most borrowers. The reasoning behind this is that programs like student loan forgiveness, be it through the student loan plan or through public service loan forgiveness, are not available on graduated and extended repayment plans. So if you're on one of these plans and you're thinking about public student loan forgiveness, the time you're putting in does not count. As a result, other plans are better options in most cases. The first income-driven repayment plan that we will look at is the income contingent repayment plan, better known as ICR. ICR also happens to be the first income-driven repayment plan that was created by the federal government. The way this plan works is that it limits your monthly payment to 20% of your discretionary income, which is a term we will explain in more detail on the next slide. By calculating payments based upon your ability to pay, if you are unemployed or earning very little, you could have monthly payments of $0. With a cap at 20%, the ICR plan has the highest monthly payment of all the income-driven repayment plans. This plan is best for people who have Parent Plus loans who are struggling to repay the debt. We single out Parent Plus loans here because they are not eligible for the new and improved income-driven repayment plans. In order to get your Parent Plus loan eligible for ICR, you do need to go through federal direct consolidation first. Your loan servicer can talk you through this process. However, if you do decide to consolidate a Parent Plus loan in order to gain ICR eligibility, be sure to only include the Parent Plus loan in the consolidation. If you add other loans that are eligible for the better repayment plans we're about to discuss, they will lose their eligibility. So be sure to proceed with care when you take this step. Discretionary income is the tool the Department of Education uses to determine how much you can afford. For most people, it's based upon their most recent tax return, specifically their adjusted gross income. However, if you have lost your job or had a pay cut, there are alternative ways of documenting your income. The government defines discretionary income as money you make that exceeds 150% of the federal poverty level in your state and based upon your family size. Note that this number does not factor in your monthly rent, other student loans, or any other considerations. As for whether or not it includes your spouse's income, it will depend upon the repayment plan you sign up for and how you file your taxes. This is something we'll discuss in a little bit more detail in future slides. Income-based repayment is one of the more popular repayment plans and usually just called IBR. IBR caps monthly payments at 15% of your discretionary income. One of the perks of IBR is that your student loan balance can be forgiven after 25 years of payments. However, be advised that the government considers debt forgiven the same as income when it comes to tax time. So in this case, if you have $10,000 forgiven in any given year, you will be taxed as though you earned an extra $10,000. The IBR plan is also eligible for public service loan forgiveness. Public service loan forgiveness comes after 10 years of certified payments. And this particular forgiveness is not taxed. If you are considering public service loan forgiveness, we have a link to an article in the video description that has a lot more detail on the program. When calculating IBR payments, the Department of Education will count your spousal income if you file your taxes jointly. So you can opt to file separately, pay higher income taxes, but get lower student loan payments. Finally, it's worth noting that there is also a plan called income-based repayment for new borrowers, but this plan only applies to very recent new borrowers and its terms are different. The next income-driven repayment plan is Pay-as-you-earn, or PAYE. PAYE was created early on during the Obama administration. PAYE caps monthly payments at 10% of your discretionary income. And the balance is forgiven after 20 years, which is 5 years sooner than IBR. Like IBR, PAYE forgiveness is taxable income. Also like IBR, Pay-as-you-earn is eligible for public service loan forgiveness. Pay-as-you-earn is also treated just like IBR when it comes to spousal income. File separately and the money your spouse earns will not increase your student loan payments. The one big limitation for Pay-as-you-earn is that only new borrowers who borrowed loans after October 2007 are eligible. If you had student loan debt before this time, you are stuck with IBR. At least that used to be the case. Last year, the revised Pay-as-you-earn plan was created. Part of the motivation behind this plan was to help borrowers who were not eligible for Pay-as-you-earn. Like Pay-as-you-earn, revised Pay-as-you-earn caps monthly payments at 10% of your discretionary income. Student loan forgiveness, regardless of employer, comes after 20 or 25 years. It's 20 years for undergraduate borrowers and 25 years for borrowers with graduate student loans. Like IBR and Pay-as-you-earn, this forgiven debt is considered taxable income. Also, like IBR and Pay-as-you-earn, REPAYE is eligible for public service student loan forgiveness. However, there are a couple ways in which REPAYE is dramatically different than IBR and Pay-as-you-earn. For starters, spousal income is included in even if you file your taxes separately. That's the bad news. The good news is that REPAYE has the best treatment of excess interest for people whose monthly payments are less than the monthly interest. On IBR and Pay-as-you-earn, when your monthly interest is greater than your monthly payment, the extra interest still has to be paid back in full. On revised Pay-as-you-earn, only half the extra interest has to be repaid. That means if you're somebody who has a $0 monthly payment or somebody who has a very small monthly payment on very large student loan bills, revised Pay-as-you-earn could have major advantages for you. Deciding on the right repayment plan can be a tricky decision. The idea behind this presentation is to aid your discussions with your student loan servicer so that you can find the right plan. Another thing to keep in mind is that you may or may not want to go through the process of federal student loan consolidation. This process doesn't lower your interest rate, but it can help you gain eligibility for certain programs. This topic could be an entirely different presentation, but for now, be sure to check out the link in the description on when you should go through federal student loan consolidation. I should also note that these rules are subject to change. As we noted with revised Pay-as-you-earn, new repayment plans occasionally come along. Changes to the student loan rules are something that we watch closely at the Student Loan Sherpa, so be sure to stay up on the latest developments. We also briefly discussed the subject of extra interest, that is, when your monthly payment is less than the monthly interest on your loans. This extra interest kind of floats on its own until your loan servicer capitalizes your interest. At that point, the extra interest is added to your principal balance and you start paying interest on that interest. If you have monthly payments that are less than the monthly interest, be sure to check out the link below to understand what events can cause your interest to be capitalized. Finally, the best suggestion for anyone with student loans is to plan ahead, research topics you don't understand, talk with your loan servicer until you're comfortable with things, and have a game plan in place to eliminate your student loans. If you have any questions for the Student Loan Sherpa, be sure to visit our forums to ask your questions and to get answers from the community. That link can also be found below.